For a long time, capital discipline was viewed as a finance function rather than a leadership trait. It was something CFOs managed in spreadsheets, while executives focused on vision, growth, and expansion. Leaders were praised for bold investments, aggressive expansion plans, and ambitious spending that signaled confidence. In 2026, that definition of leadership has changed. Capital discipline is no longer just a financial responsibility. It has become a core leadership skill that shapes credibility, resilience, and long-term success. This shift did not happen overnight. It is the result of years of economic volatility, rising interest rates, tighter capital markets, and repeated shocks that exposed the cost of poor capital decisions. Companies learned that strong leadership is not defined by how much capital you deploy, but by how wisely you allocate it. In an environment where capital is expensive and uncertainty is persistent, discipline has become a form of strategic intelligence. Capital discipline begins with understanding trade-offs. Every dollar allocated to one initiative is a dollar unavailable for another. Leaders today must constantly choose between growth, stability, flexibility, and resilience. These decisions are no longer theoretical. They have immediate consequences for cash flow, risk exposure, and organizational health. Leaders who lack capital discipline often commit resources based on optimism rather than durability. One of the biggest reasons capital discipline has become a leadership skill is the higher cost of mistakes. When capital was cheap, errors could be absorbed or corrected with additional funding. Projects could run over budget. Acquisitions could underperform. Expansion could outpace demand. In many cases, those mistakes were survivable. Today, higher interest rates and tighter financing conditions magnify every error. Poor capital decisions now have lasting consequences. Leadership teams are increasingly judged by how they manage downside risk, not just upside potential. Capital discipline forces leaders to ask uncomfortable questions. What happens if growth slows? What if costs rise faster than expected? What if demand shifts? Leaders who ask these questions early can adjust strategy before problems escalate. Those who avoid them often discover the answers too late. Another reason capital discipline has moved into the leadership spotlight is credibility. Investors, boards, and employees are paying closer attention to how leaders handle capital. Promises of growth mean little if they are followed by write-downs, restructurings, or layoffs. Leaders who consistently allocate capital carefully build trust. Their decisions appear intentional rather than reactive. Over time, this credibility becomes a competitive advantage. Capital discipline also shapes organizational behavior. Leaders set the tone for how resources are treated. When executives spend freely and justify decisions with vague strategic language, that mindset spreads. Teams learn that budget overruns and unclear returns are acceptable. When leaders demonstrate discipline, ask for clear justification, and phase investments carefully, the organization follows. Discipline becomes cultural rather than enforced. One clear example of this shift is how leaders approach expansion. In the past, expansion often meant committing capital early and scaling quickly. Today, disciplined leaders favor staged growth. Investments are released in phases. Performance milestones matter. If assumptions prove wrong, leaders are willing to pause or reverse course. This requires confidence and restraint, both of which are leadership traits. Capital discipline is also closely tied to decision reversibility. Leaders are increasingly distinguishing between decisions that can be undone and those that cannot. Reversible decisions are treated as experiments. Irreversible decisions are scrutinized heavily. This framework helps leaders avoid locking the organization into fragile paths. Knowing when to slow down is now as important as knowing when to act. Technology investment highlights why this matters. AI, automation, and digital systems require significant capital and long-term commitment. Disciplined leaders resist the pressure to invest aggressively just to signal relevance. Instead, they demand clear use cases, phased deployment, and measurable outcomes. They understand that technology spending without discipline can weaken the organization rather than strengthen it. Mergers and acquisitions further illustrate the leadership dimension of capital discipline. Large deals often promise strategic transformation, but they also introduce integration risk, cultural disruption, and financial strain. Disciplined leaders approach acquisitions cautiously. They challenge synergy assumptions, stress test downside scenarios, and walk away when deals do not meet strict criteria. Knowing when not to buy has become a mark of strong leadership. Capital discipline also influences how leaders manage cash and liquidity. Holding reserves was once criticized as inefficient. Today, leaders recognize that liquidity provides control. Disciplined leaders ensure the organization has the financial flexibility to respond to shocks, invest opportunistically, and avoid forced decisions. This requires resisting pressure to deploy every available dollar. Workforce decisions are another area where capital discipline shows up clearly. Hiring ahead of demand ties up capital and increases fixed costs. Disciplined leaders align headcount with confirmed needs and invest in productivity rather than scale alone. This reduces the likelihood of disruptive layoffs and preserves long-term organizational strength. Investor communication has changed alongside leadership expectations. Disciplined leaders are more careful with guidance and promises. They avoid projecting aggressive outcomes that depend on ideal conditions. Instead, they communicate realistic plans and explain how capital decisions support durability. This transparency builds confidence even when growth is modest. Capital discipline also requires emotional control. Leaders often face pressure to act quickly, match competitors, or pursue visible growth initiatives. Discipline means resisting urgency when it is not justified. It means being comfortable with slower progress if it preserves long-term value. This emotional restraint is a leadership skill that becomes more valuable in uncertain environments. Another reason capital discipline is now central to leadership is the interconnectedness of modern businesses. Capital decisions affect operations, culture, risk exposure, and reputation simultaneously. Leaders can no longer treat capital allocation as a narrow financial exercise. It is a strategic act that shapes the entire organization. Boards increasingly expect this mindset. Directors are asking tougher questions about capital use, return thresholds, and flexibility. Leaders who demonstrate discipline earn greater autonomy and trust. Those who do not face increased oversight. Capital discipline has become a key factor in leadership evaluation at the highest levels. Importantly, capital discipline does not mean avoiding risk or innovation. It means choosing risks deliberately. Disciplined leaders invest where returns are durable and aligned with strategy. They avoid investments that depend on perfect execution or favorable conditions. This selective approach allows innovation without fragility. This shift has also changed how success is measured internally. Leaders are evaluated not just on growth, but on return on invested capital, cash flow impact, and resilience. Capital discipline is rewarded as a sign of maturity and competence rather than caution. In 2026, why capital discipline is now a leadership skill comes down to one reality. The environment no longer forgives careless capital decisions. Growth alone cannot compensate for poor allocation. Strong leadership is defined by judgment, restraint, and clarity under uncertainty. Leaders who master capital discipline are not necessarily the most aggressive. They are the most intentional. They understand the cost of capital, the risk of irreversibility, and the value of flexibility. They know when to invest, when to wait, and when to walk away. In a business world shaped by volatility and tighter constraints, capital discipline separates leaders who react from leaders who endure. It has become a defining skill, not because leaders want it to be, but because the environment demands it.